When it comes to investing, Warren Buffett has an incredible talent for spotting companies with long-term value, generating massive returns over time. Buffett uses it to dig deep into a company's financial health and uncover hidden gold mines that others might miss. Today, I'll walk you through his exact approach to analyzing a balance sheet based on insights from Warren Buffett and the interpretation of financial statements by Mary Buffett and David Clark. By the end of this video, you'll have the confidence to analyze companies' balance sheet like Warren Buffett and spot high-value investment opportunities. Let's get started. So what is a balance sheet and what does it matter? The balance sheet gives you a snapshot of a company's financial health at any given time. Think of it like a report card for a business. It shows how well a company manages its money, assets, and debts. Buffett looks at the balance sheet to figure out if a company has a durable competitive advantage, meaning it's well positioned to succeed for the long term. Now let's break down the three main sections of the balance sheet: assets, liabilities, and shareholders' equity. Assets, what the company owns. Assets represent everything a company owns and are divided into two categories: current assets and non-current assets. Current assets, these are assets that can be turned into cash within a year. Current assets are critical because they show how well a company handles its short-term obligations and operations. Cash and cash equivalents. This is the actual cash a company has on hand or in bank. Buffett loves companies with large cash reserves. Why? Because it shows that the company generates strong earnings and is prepared for unexpected problems while also being able to invest in future growth. On the flip side, if a company is low on cash, it might struggle during tough times, which is a warning sign for Buffett. Accounts receivable. This is the money customers owe the company. Buffett looks at how quickly the company can collect this money. The faster, the better. It means customers are paying on time, which is a sign of healthy business fundamentals. Inventory. Inventory is the products a company keeps to sell to customers. Buffett closely watches whether the company's inventory level match its sales. If a company's inventory is increasing while sales stay flat or drop, it's a red flag that the company isn't selling products as expected, which can lead to losses. Non-current assets. Non-current assets are long-term investments or property that the company plans to hold for more than a year. And these assets are critical for driving long-term value. First, long-term investments. These are assets a company plans to hold for more than a year, like stocks, bonds, or real estate. A company's long-term investments reveal management's mindset. Are they investing in businesses with durable competitive advantages or in highly competitive markets? Second, property, plant, and equipment, PP&E. These represent the company's buildings, factories, and machines. Buffett prefers companies that don't need to constantly upgrade their equipment. For example, Wrigley, the chewing gum company that Buffett invests in, doesn't need to upgrade equipment regularly because their process stays the same, allowing them to save money for other opportunities. Third, goodwill and intangible assets. Goodwill is a premium a company pays when it buys another company. And intangible assets include patents, trademarks, and brand value. Buffett is cautious when looking at goodwill because it only holds value if the acquired company performs well. If the purchase turns out bad, that goodwill could become essentially worthless. The bottom line, Buffett prefers companies with solid tangible assets over those reliant on goodwill. Now that we've covered what company owns, let's talk about what it owes. Liabilities are essentially the company's debts and obligations. And like assets, they're split into current and long-term categories. Current liabilities. These are debts that need to be paid within a year. Keeping an eye on current liabilities gives you a sense of how well a company is managing its short-term financial commitments. First, accounts payable. This is the money a company owes to its suppliers. Buffett checks if the company can easily pay these bills. If accounts payable is rising faster than revenue, it's a bad sign because it may mean the company is struggling to pay off its suppliers. This includes loan or any money the company has borrowed that must be repaid within a year. Buffett dislikes companies that rely too much on short-term debt because it adds unnecessary risk. If the company can't repay its debts, it may be forced to take on even more loans, digging itself into a deeper financial hole. The next is long-term liabilities. Long-term liabilities are debts the company won't have to repay for more than a year, such as long-term loans and bonds. Buffett prefers companies with little or no long-term debt. Why? Because companies with large debt loads have to use their profits to pay interest, leaving less money for growth or returning value to shareholders. Companies like Coca-Cola have a durable competitive advantage because they don't rely heavily on debt to operate. In contrast, companies like Ford or General Motors often carry significant debt, making them more vulnerable during economic downturns. Now let's talk about the third section on balance sheet: shareholders' equity. What belongs to the shareholders? Shareholders' equity is what's left after a company subtracts its liabilities from its assets. It's essentially the portion of company that belongs to shareholders. First, common stock. This represents the money shareholders have invested in a company by buying shares. For Buffett, the size of the common stock can show how much faith investors have in the company's future. Second, retained earnings. Retained earnings, the profits a company saves and adds to previous years, represent an accumulated number and are one of the most important figures on a balance sheet. Warren Buffett values companies that grow their retained earnings because it shows they are reinvesting to strengthen the business. Some of his favorite companies include Coca-Cola, growing its retained earnings by 7.9% annually, Wrigley by 10.9%, Burlington Northern by 15.6%, and Wells Fargo by 14.2%. And topping them all is his own company, Berkshire Hathaway, with an impressive 23% growth, increasing its value in $19 per share in 1965 to $680,000 by 2024. Retained earnings are crucial for growth. If they aren't increasing, the company's net growth isn't growing. And growing retained earnings means reinvesting in the business and growing long-term wealth. Treasury stock. Treasury stock refers to the shares that the company has bought back from the public. When a company buys back its own shares, it reduces the total number of shares available. With fewer shares in circulation, each remaining share represents a large portion of the company's ownership and profits, potentially increasing its value as a result. Buffett prefers companies that buy back shares when they believe the stock is undervalued, as it's a sign that management believes in the company's long-term value. Now that we've gone over the balance sheet, let's break down some of the most important metrics Warren Buffett uses to evaluate a company's financials. Return on shareholders' equity, ROE. ROE measures how well a company is using shareholders' money to generate profit. It's calculated by dividing net income by shareholders' equity. And a high ROE means that management is efficiently using shareholders' money. Buffett looks for companies with a consistent ROE above 15%. For example, Coca-Cola has an ROE above 30%, meaning it's highly efficient at turning shareholder investments into profit. And companies with high stable ROEs typically have strong management teams and solid business models. However, Buffett is careful about companies that make their ROE look better by taking on too much debt. This might make them seem more profitable at first, but it can be risky in the long term. Return on assets, ROA. ROA shows how effectively a company uses its assets to generate profit. It's calculated by dividing net income by total assets. A higher ROA means the company is efficient at turning its resources into profits. It can also signal a competitive advantage, showing that the company can generate profit with fewer resources, making it more resilient over the long term. And companies with the ROA of 10% or higher are generally efficient and not wasting resources. Buffett likes companies with high ROA because it shows they're managing their assets well as long as they're not taking on too much debt. Debt to equity ratio. The debt to equity ratio shows how much debt a company uses compared to its equity. You calculate it by dividing total liabilities by shareholders' equity. If the ratio is below 1, it means the company is using more of its own money than debt, which is generally safer. If it's above 1, the company has more debt than equity, which can be riskier. And a lower debt to equity ratio suggests the company is financially stable and better able to handle tough times. For instance, Procter & Gamble has a low ratio, making it a safer bet during recessions. Buffett usually looks for a ratio below 0.8, which means the company isn't too dependent on debt for growth. But keep in mind, the number isn't everything because some solid companies like Moody's might buy back stocks, which reduces their equity and make the ratio look higher than it really should be. So always look at the bigger picture when assessing a company's financial health. Lastly, Warren Buffett avoids leverage. Leverage refers to the amount of debt a company uses to grow. While leverage can increase profits in the short term, it comes with risks. Buffett avoids companies that rely too much on leverage because if a company has borrowed too much, it may struggle to pay its debts if its profits drop. This kind of risk is why Warren Buffett prefers companies that can generate profit without needing to borrow heavily. And a famous example is the collapse of Bear Stearns during the 2008 financial crisis. The company relied too much on borrowed money and couldn't repay its debts when the market turned bad. So no leverage. So you're basically playing with fire. And there you have it. That's how Warren Buffett looks at a balance sheet to find companies worth investing in for the long term. By following these steps and principles, you'll be able to analyze a company's balance sheet with confidence and make better investment decisions. If you have any questions or thoughts, drop them in the comments below. Thank you so much for watching till the end. And if you found this video helpful, don't forget to give it a thumbs up and subscribe for more.